Seen the headlines. A huge new trade deal between India and the European Union just got finalized. Now, most of the talk is about the politics, right? But the real story, the one that investors should be paying attention to, is happening kind of behind the scenes. We're going to break down what this deal actually means for where the money is going. You know, in the world of finance, a deal like this isn't just another piece of news. It's a massive signal. The market sees it as directional money flow. And yeah, that sounds a bit clinical, but what it really means is that this is a fundamental shift. It's about where the big, serious money is going to be placed for years, even decades. And that's exactly what we're going to unpack here. Okay, so let's push past all those political headlines for a second. The thing about these huge trade deals is that they don't create overnight millionaires or instant winners. Nope. They're more like a slow burn. They work quietly, methodically, to completely change the ground rules for where and why money gets invested in the first place. And that brings us to what is, honestly, the single most important word for anyone managing serious long-term money: predictability. I mean, think about it. If you're responsible for billions of dollars, the ability to forecast what business conditions will look like 5, 10, even 20 years from now, well, that's the holy grail. It's so much more valuable than any flashy headline or short-term market jump. So the big question is, how does a super complex agreement like this actually create that predictability we were just talking about? Well, it really just boils down to three main things. When you strip it all away, the deal does three really simple but powerful things. First, it cuts down on tariffs. You know, those taxes you pay on goods when they cross a border. Second, it simplifies the rules, which basically means getting rid of a ton of paperwork and bureaucratic headaches. And third, it improves market access. The whole point of all this? To make doing business between these two massive economies way easier, cheaper, and, there's that word again, more predictable. Okay, this is where it gets really interesting. Let's trace how a government policy decision actually makes its way onto a company's balance sheet, because this is key. The real impact of a trade deal almost never shows up in those crazy daily stock charts. Nah, it's much slower. It shows up bit by bit in the actual financial health of a business. So, it all kicks off with something pretty simple, like those lower tariffs we just mentioned. Right away, that means companies have a lower costs to deal with. And lower costs, well, that opens the door for higher profit margins. Simple as that. And then the next domino falls. Over time, those healthier margins start to show up as stronger revenues and, crucially, much more robust cash flow for the company. And here's the final piece of the puzzle. It's these solid, steadily improving numbers that ultimately give serious, long-term investors the confidence they need to put their money in. See, they're not betting on hype or a cool story. They're investing in real, proven financial strength. But, and this is a really big but, for any of this to actually stick around for the long haul, there's a critical rule. The deal can't be one-sided. For that big money to feel confident enough to build a factory or sign a 20-year contract, it has to be a clear win-win for everybody involved. And this is what we mean by a two-way street. For India, you're looking at more efficient exports and way more predictable revenue streams. That's huge. And for the EU, they get better access to India's absolutely massive consumer market, plus more stable partners for their supply chains. When both sides are getting that kind of value, suddenly those big commitments, like building a new factory, start to look a whole lot more attractive. So who are the big potential winners in India from all this? Well, you're definitely looking at manufacturing, textiles, pharmaceuticals, and also engineering and auto parts. These are all sectors that get a direct boost from having easier access to European markets and more predictable demand for their goods. Okay, let's bring this all home. What's the real takeaway for an investor? The most important thing is to kind of shift your thinking. It's less about trying to pick one specific winning stock, and way more about understanding the big, powerful themes that a deal like this puts wind into the sails of. We're talking about major themes like export-focused manufacturing or companies that are really good at integrating supply chains. These are the kinds of long-term trends that reward businesses with discipline and a real vision for the future, not the ones just trying to make a quick buck. But you know what? To really get this, it's just as important to talk about what this deal does not mean for investors. So let's bust a few common myths right now. All right, time for a quick reality check. This deal does not mean you're going to see immediate stock market rallies. It for sure doesn't guarantee profits for anybody, and it is absolutely not a one-way street where only one side wins. I'm going to say this again because it's so important. Trade agreements change the direction of an economy, not its speed. And this really brings us to the most important concept in this whole explainer, friction reduction. The best way to think about it is like this. It's the gradual, patient removal of all the little things, the little obstacles that make trade and investment a pain. It's not dramatic, it's not flashy, but its positive effects compound, they build on each other powerfully over the years. And honestly, this is the real lasting impact that impatient investors almost always miss. Look, here's the bottom line. This deal isn't exciting in the way a hot new stock is exciting. And that is exactly why it matters so much. True, lasting financial strength is built on boring stuff like stability and predictability, not on short-term hype. So if we boil it all down, what does serious, long-term capital really want? It's these three things, right here: stability, predictability, and policy alignment. And the reason this India-EU trade deal is so powerful is because it quietly makes all three of those things just a little bit better. And let's just end on this one final thought because it's a great rule of thumb. Smart money always watches where friction is being removed. See, deals like this don't reward people who are impatient. They reward people who get positioned for the future. They're like a quiet signal pointing to the future direction of trade and investment long before it becomes obvious to everybody else.